Hey there, it's Dave Cleary from Timberpoint Capital Management, and welcome to our 3-minute market and economic update. A lot going on this week. Tuesday, we had the CPI print. Yesterday, we had the Fed announcement of 50 basis point increase, and the ECB followed suit today. And markets are not happy at all, as it seems like central bankers are doing their very best to cause a recession here. Investors of all types are becoming very concerned. For example, this week, BlackRock published its 2023 outlook, and it was very dour. They're forecasting a continuation of strong inflationary pressures, continuation of tight monetary policy, which is going to cause a meaningful recession into the next year. As you would imagine, their investment implications are pretty negative given this outlook, and they advise investors to remain defensively postured across both equity and bond markets. We too are very concerned about a pending recession, but we don't fully concur with this outlook. In fact, we think that there is a plausible scenario where we have a not too hot, not too cold economy in 2023. First and foremost, inflation is getting better. Across every metric, inflation has declined from its peak. And with the exception of employment costs, the key underlying components of inflation are improving. Just this week, we got a very encouraging CPI print. The market responded favorably, and we think that that is very good news. On the economic growth front, the news is slowing, but it's constructive enough. According to the Atlanta Fed and their GDP Now report, real economic growth continues to run in the 3 to 4% range. Despite the higher interest rate regime, overall employment trends remain solid, and by extension, consumer spending should hang in there. These are the key components of the U.S. economy. We've had some layoff announcements hit the tape, and hiring plans are down from highs, but overall, the employment picture remains solid. Very aware that the yield curve is inverted, and that's not a great economic signal, and other economic indicators point to a slowing economy as well. Global PMIs, for example, are now down below 50, and that indicates that a recession is pending. These data points should be taken very seriously, and we'll continue to monitor them. From our standpoint, the biggest risk remains a monetary policy mistake, and possibly one has already occurred. Yesterday, as expected, the Fed tightened by 50 basis points, and Jerome Powell continued to talk markets down by indicating that the Fed will continue its tight monetary policy into the next year. ECB followed suit today, but the market isn't completely buying it, as expectations are that rates will begin to fall in the out months of 2023. Also, when you look at market traded metrics like high yield spreads, small cap stocks, and volatility, they're all telling us that things are okay. I'm not saying great, but not terrible either. So again, a Goldilocks economic environment is a plausible scenario for 2023. We'll get into investment implications on another video, but whether or not we enter a recession really is the key variable that's going to determine whether or not investors are going to be compensated for taking risk into the new year. Thank you. Hope you found this helpful, and please reach out if you have any questions whatsoever. Have a great weekend.